Joining us, Danny Kirsch, is the head of options at Piper Sandler. Danny, what do you think about this big relief rally we're getting here today? Not a lot of pushback. Seems like bears are kind of empty-handed today.
Yeah, I think that there was like this consensus and that CPI would come in hot. Like one way that like you can see this is the expectation for the headline CPI moved from 0.3 to 0.4 2 days ago. So it was sitting at 0.3 and then it shifted up a little bit. So that just kind of tells you everyone's expecting a high print. The headline came in line, but the core coming in gives everyone some pause. And some of the feed through to the PCE, which the Fed cares the most about, point to a lower PCE at the end of January. So all of this speaks to, I think, this got pretty crowded, this short long end trade unwinding to some extent. You're not going to get huge rally in rates, but anything that sort of staves off the fear of actual hikes. Clearly, the market wanted to see. The market's been dying for it. And you got this decent day in the Russell, really good day in financials, especially like the larger cap names. And that combined with really strong earnings this morning. So you kind of had the double whammy in XLF, which is helping kind of get things moving. And we're at a strong seasonal period. And next week, the new administration starts.
What do you think about the bank trade? Just to kind of go off on that tangent for just a moment. You've traded the regionals back and forth over the last couple of years with us on the show. It seems like still kind of a petri dish for measuring the market's assessment of growth versus inflation. When the curve flattens a little bit, they kind of fade. When we get steepening, they like it generally. What do you think we should be looking for the group?
I mean, regionals are sort of acting like a levered rate play at this point. If you think the long end rallies, which we think it will, we think long end rates will come down. Regional banks should act extremely well, especially as M&A picks up, which is an inevitability under the new administration. There'll be more mergers. We think that this will continue to work. Obviously, it's well off the post-Trump highs. My guess is it gets back there over the next 6 months. I think XLF, though, is also a buy. I mean, XLF implied volatility is extremely low. We were buying June call options today for the next round of earnings, for the first 6 months of Trump, for the deregulation push. It just seems like banks should be a winner over the next few months. And it's kind of the easier trade too, because again, implied volatility is well off the highs.
Okay. It sounds pretty bullish overall. Economically, market-wise, are the two in sync? If you're saying that rates are going to come down, banks are going to love that. That sounds like a pretty good situation for the economy. Is that going to be good for the market as well then?
Absolutely. I think the combination of lower rates and deregulation, it should be very strong for the market. While we do like the regional banks, we think banks will work. We don't think everywhere is a winner. In like one sector today, I think it was red as I hopped on, it was the consumer staples. We see more downside there. It just seems like there's a lot of headwinds. And as people sort of look for potential opportunities to the upside, it's like you're going to need to find a source of funds. And consumer staples has been an area where I think people have been hiding out for years. It's been fine. It's kind of been an underperformer, sleepy. I think this is the next couple of years going to be a really challenge. You've got RFK. I think the betting markets have an 85% chance of being confirmed. So assuming he's confirmed, this has clearly been important to him. There were headlines today that they want to ban the red dyes. They want to cut the nicotine in cigarettes. There were quotes months ago from RFK on the brighter colors and Fruit Loops might look nice, but they're poisoning our kids. Margin compression, people are drinking less. It just seems like there's a lot of negatives, not to mention they're a tariff loser, consumer staples. It just seems like there's a lot of negatives for that space, and we see that acting as a source of funds. So we've actually had clients buying financials, selling, and using consumer staples to fund their long financials. You can do a trade where you sell XLP calls. That's the consumer staples ETF to fund XLF calls. I like that. XLP vol is a little bit elevated because it's underperformed. But you can also just buy XLP put spreads. Puts and put spreads earnings are coming down the pike, and it just seems like there's a lot of headwinds. And if you are worried about inflation, and certainly the one negative on the CPI report was on the food side. You saw egg prices are exploding. Hershey's is trying to load up on cocoa and go above CFTC limits in order to get exposure because they're worried about prices running higher. Like, this is who loses, and as these margins get compressed, if rates stay elevated, not to mention the regulatory environment, it just seems like there's a lot of downside for the consumer staple space. And if we are getting to get a big cyclical rally, you definitely don't want to be there.
All right, like that. A lot of logic adding up there. Pretty airtight case. I got nothing against that. Sounds pretty good.
Are you dying to buy Pepsi? Is that exciting you to buy Pepsi right now?
Dying to buy Diet Coke. Not Pepsi.
Yeah, Diet Coke.
No, I don't think anybody is. Especially because, to your point, some of the inflation stuff is still lingering there in terms of their profit margin pinch, aluminum prices, et cetera.
Yeah, it just seems like there's a lot of areas for them to lose, and they'll be a tariff loser on imports, and who knows what kind of what the responses will be to U.S. tariffs if other countries start tariffing what things that we export, and there could just be, they seem to be in the crossfires of a lot of negative headwinds, and at the same time, volatility is low. We see this margin compression, and I think it's been sort of a quiet crowded long. It's not a crowded short. That's certainly not the case. So we've been adding puts there. We've been adding downside, and it's slowly been trickling lower the next few months. And even today, again, down 21 bips in a really strong tape.
The Staples fade has seemingly already been underway. So is that going to change any of the options pricing, or is it still pretty cheap in terms of volatility?
Yeah, volatility is still very, very reasonable. We're looking at like 3-month 10 delta puts. It's near the lowest they've been over the last 5 years. Like, again, it's just very inexpensive to own options because it's not a super volatile underlying, and nor should it be. But you can see it can certainly trend lower as people sell out of these stocks and maybe look for a little more torque in other places. We think financials will continue to work. Clearly, tech is acting really well today. Consumer should be okay, assuming employment hangs in, which employment seems like it's fine for now. And then one other area we've looked for upside that's been a laggard, a massive laggard, a rates loser has been healthcare. Healthcare, as of now, is the lowest percentage of the S&P as a sector. It's been, I think, in the last 20 years. The weighting is collapsed. I think people are, again, concerned on RFK and vaccines and getting drugs pushed through. We think that concern is overblown. I think it's valid on the food side, not as valid on the healthcare side, especially on the biotech side. We like XBI call spreads. We've flagged that shares outstanding of XBI are near multi-year lows. The exposure, we think it's kind of washed out at this point. And if you do get some just rates to stop going up and perhaps come down, we think XBI could be a huge winner over the next few months, over the next month. And again, they should be a winner on the deregulation side too, as the FDA potentially looks to push through the solutions for more rare diseases.
All right. I love it. So a long view on XBI, a long view on banks, a short view on Staples, and maybe the funding mechanism by which to express some of those more optimistic trades. Specific, helpful, creative. Thanks a lot, as always, Danny Kirsch.
Hey, thanks for having me. Appreciate it.
Good stuff. Nice, unique take there. As always, putting on some trades and strategies in a market that is firming up today. Doesn't need the Staples. Thanks, Danny Kirsch. Piper Sandler coming up.